Suggested we were under pressure today, but we recovered considerably from the low point of the day. Hello and welcome to CNBC-TV18. You're tuned in to Markets Today, the show where we track around 6 hours of the day's trading action and cover it in top 5 headlines. I'm Nigel D'Souza. Let's run you through the headlines for the day. A late putback helps the Indian indices close flat after taking heavy losses early trade, triggered by a surprise move by Japan's central bank. Reliance and IT stocks lead from the front, while concerns on China's reopening drag the realty stocks. Asian equities fall as the Bank of Japan shocks global financial markets by unexpectedly doubling the cap on its 10-year yield. The news also sparks a yen rally. Metal stocks lose sheen as metal prices drop on concerns of waning demand. Hindalco, JSPL, JSW Steel and Tata Steel, all of them end with cuts of around 1%. Just slides 2% after Reliance Retail Ventures announces plans to trim its holdings in the company to meet the minimum public shareholding norms. Sterling and Wilson also sees red after the promoters, Shapoorji Pallonji and the company, as well as Khurshid Yazdi Daruwala, will sell up to 5.27% stake in the company. Hinduja Global Solutions slides 3% after it offers to buy a chunk of its shares at a hefty premium. Meanwhile, Shipping Corp of India closes with gains after hitting 52-week highs in trade, as an update in the company's demerger process and increase in tanker rates boosts the stock. Well, here's what we have lined up on the show for you. It's a power-packed show, as always. In Market Opinion, we have Dan Feynman of Credit Suisse, as well as Abhilash Narayan of Standard Chartered Bank. And Big Corporate Voices will be joined by Suresh Narayan, CMD of Nestle, on the outlook for the next year. Well, as has been the case, it was a volatile trading session on the Wall Street. The indices took on heavy losses in the first hour of trade that was triggered by persistent fears of global recession next year and a surprise move by Japan's central bank. However, the Nifty and the sensex, well, they staged a late pullback, and they ended with only minor cuts. The sensex was down close to 100 points. The Nifty was down only around 35 points odd. Reliance and the IT stocks, well, they led from the front. Prashant standing by to run us through all of those details. Well, Prashant, another volatile day of trade.
Well, today was a story of incredible amount of pullback, both on the Nifty and the Bank Nifty. The day started lower, and it only went deep into the red as the Bank of Japan actually came out and did something which no one expected them to. They took up the level to which they are allowing the yields to trade in Japan. That sent shockwaves. Markets around the world came off. But in the last 2 hours or so, things got better. Global markets did a little better. US futures calmed down. And here there was a very strong recovery as well. It was a normal kind of a correction by close, some 40, 50 odd points in the Nifty, and the banks as well doing quite okay. Broader markets also saw a pullback. Both the mid-cap and small-cap index intradays will tell you that. What led the pullback, the one common name between yesterday and today was Reliance Industries, top contributor to the pullback. These are not day-on-day top gainers, but what contributed the most? TCS, which was a loser on the other side yesterday, contributed a number 2 place. ICICI Bank, Axis Bank and Adani Enterprises were some of the other top contributors. Under pressure, SBI Life was a meaningful loser. iShares and UPL were the other Nifty cuts. What was under pressure? We've been highlighting over and over again the fact that PSU banks are pulling back. The PSU bank index from the middle of last week is down 7.5%. UCO, IOB, Central Bank, sugar names have had 2 days of rally. They all pulled back. Sakti, Dalmia, KCP. And there were names like Godrej Properties, Angel One, and a few others which came off. Some railway stocks that came back into rotation on the gaining side. IRFC, RVNL, FACT was higher. There was PNB Housing which did well. And there was something like a Gravita India which did well as well. I mean, pretty volatile to be fair, not just here in India, but what we're seeing out there in the US as well. The 20-day, I think, remains the level which the market needs to take out, as we've been saying, for more bullishness to come back. And that lies about 100 points away from where the market left off today. Back to you.
Thanks a lot for that, Prashant. Well, time to get in some expert opinion. Dan Feynman, co-head of equity strategy Asia Pacific at Credit Suisse, said that a recession in the US as deep as the one in 2008 would be bad for Asia and emerging markets, but a slowdown of that magnitude that they are expecting could actually benefit Asian economies. Let's hear him out.
I think if we have a very hard landing in the U.S. of a recession as deep as the great global recession in 2008, 2009, that would be bad for Asia and emerging markets. But a slowdown of the magnitude that we're expecting for the U.S., actually, it could be pretty good for Asia. One factor is it could lead to a weaker dollar, and a weaker dollar typically is associated with good performance for emerging markets, Asia included. I think that India still has some important strengths relative to other markets in the current global environment. India has a very robust economic cycle. It's got a good structural outlook in an environment where developed markets are heading into a slowdown. India's good growth, I think, deserves to trade at something of a premium. Deep recessions are typically associated with deleveraging events, and that's not the situation at present. What we have is a garden variety, fairly mild, short-lived recession lying ahead of us.
Well, moving to the second headline now, the Bank of Japan shocked the global financial markets by increasing the cap on the 10-year yield from 25 bips to 50 bips. Asian equities, they fell, and the yen strengthened after the announcement. Lata joins us to tell us more about this hawkish turn by the central bank. Lata?
Basically, the Bank of Japan is going to allow the yield on the 10-year to rise from 0.25, where it was capping it, to 0.5%. Just for those who are not following Japan very closely, the Japanese central bank has had a policy of yield curve control, YCC as they called it. It was a way to keep yields low so that they could kickstart the economy. Now that is coming under a bit of a question because globally yields have gone up so much that, as the BOJ says, is creating financial issues. And Japanese inflation has gone up to almost 2%, 1.99. Previously, it was in 2014 that it had seen such levels. After that, it has been, even negative numbers in terms of Japanese inflation. So there was a need. But it was a totally unexpected move. The current BOJ governor is going to retire or end its term in April, and any change was expected only then. So the market is totally not positioned for this change by the third largest economy. Now, why is it important? It's a sign that the last major central bank has also pivoted and become hawkish. It is believed, the market's perception is now this means that Japan will exit its loose policy. It was the only, the cross-asset funding by using yen was a very large trade because it was the only cheap currency. You could take cheap yen loans and then cross-fund other assets. That source now is kind of drying up. Japanese investors, a lot of Japanese money has been invested in US treasuries. As it is, the Fed is going to buy less and less. There's already a tightening there. One more set of people may stop buying. When Japanese investors, who are among the biggest globally, find that there is a little more money to be made in their own assets, they may flee or at least move a little bit out of other assets as well around the world. That explains why you saw risk assets everywhere falling. And then the last and the most important impact, Japan is the third largest economy. A rise in rates over there can reduce Japanese pace of growth as well, such as it is, however, slow that pace has been. So this is definitely only slightly less important than, you remember Powell's pivot in end November 2021, it's almost as important an event as that, according to market participants.
Okay, all right, Lata, thanks a lot for decoding that for us. Well, the latest move by the Bank of Japan shows the most dovish central banks are also trying to tighten policies. And that's the word that's coming in from Abhilash Narayan of Standard Chartered Bank. Let's hear out what he had to tell us earlier today.
Effective tightening of policy came as a surprise to the markets, and that's why we are seeing such sharp market reaction. I think the other reason why we've seen equity markets slide down is because Bank of Japan was the last bank which was still holding on to accommodative policy. So with the shift that we've seen in Bank of Japan's stance just now, what it means is that even the most dovish central bank is looking to effectively tighten policy by allowing bond yields to move higher, and that at the margin has hurt the sentiment for the equity markets. Equity markets could remain under pressure for the next few sessions, given the shift in policy that we have seen. If I look at the implication for, let's say, Japanese yen, we've seen that dollar yen has moved lower by around 2.8%. And what today's move can mean is that we could see dollar yen touch even 130 potentially over the next couple of days. So that could be the big move in currency markets. But yes, it's the timing and the surprise element that is leading to such a sharp market reaction, in our opinion. We are still a bit more cautious on the equities over the next 1 to 3 months, and we've recently gone underweight global equities as well.
Meanwhile, Paul Schutz of Schutz Research says that Japan is still 300 basis points behind the United States and that the Bank of Japan is under immense pressure to react to the changing policies by other central banks. Let's hear him out.
Profound pressure inside the Bank of Japan to get the Monetary Policy Committee of the BOJ to get its act in order and start to raise interest rates. So I think this was something that could not be fended off anymore, especially after the rate rise in the U.S. Last week. That's the first thing. The second thing is Japan is still miles behind everybody else. I mean, Japan is 300 basis points behind the U.S. And so this is, at this point, this is barely nothing relative to other central banks, even in Europe. I think this is not a pivot. I think this is a technical surrender to the hawks inside the BOJ, who were furious with the top leadership of the BOJ for being so asleep. And so I think this is a little bit of a capitulation, not a pivot.
Well, coming back home then, Bank of Japan's surprise policy tweak has weighed on auto major Maruti Suzuki. The stock was already under pressure after the chairman, Mr. R.C. Bhargava, said that high taxation on automobiles was impeding growth of the industry. Parishit Luthra, well, he's joining us to tell us more about Maruti chairman's comments. Parishit?
Meeting of Maruti Suzuki with the media, there R.C. Bhargava expressed concern about the high rate of taxation. We asked him about his reaction to the clarification on SUVs, the cess and taxation on SUVs, and the possibility of MUVs being taxed at a higher rate as well. R.C. Bhargava said, how can we really expect the industry to grow when the tax rate on SUVs is 50%? He also said that they leave it to the wisdom of policymakers. If the policymakers don't want the auto industry to grow, or they're comfortable with the auto sector growth of 5 to 6% annually, then he won't fiddle with the wisdom of policy making. He also said that we need a rationalization of tax brackets across the automotive sector with a special focus on reducing the regulatory burden on small cars. He says that the auto industry, if it has to grow, then the small car segment must continue to grow. And right now, because of the tax burden, the market is shrinking. When it comes to new launches, Hisashi Takeuchi of Maruti Suzuki said that they will be showcasing 2 new SUVs in the Auto Expo. There will be an electric SUV concept also showcased. We're learning from our sources that one of the SUVs will be a rival of the Thar, the 5-door Jimny that will be launched by Maruti Suzuki later next year. We'll also see a rival of the Sonnet that is also slated for a 2023 launch that will be seen at the Auto Expo from the Maruti Suzuki stable. On FTAs, R.C. Bhargava says that we must drop the protectionism attitude. We must be open to reducing tariffs and get access to global markets for Indian automobile exports.
Well, moving to the third headline today, metal stocks, they lose their sheen as metal prices fell on concerns of waning demand. Hindalco, JSPL, JSW Steel and Tata Steel, all of them closed with cuts of around 1%. Manisha is standing by to run us through with a quick analysis on that. Manisha?
Well, after a good month in November and most part of December as well, we are looking at some profit taking coming in for metal prices. And this is because of the surging COVID cases in China, which have hit the industrial activity and other sector as well. Also, when you look at the housing prices in China, those have declined the most in last decade. The investment in fixed markets, etc., also seems to be declining. China actually has reported 5 new COVID deaths for December 19th, and that really seems to have soured the mood and sentiment here. Also, as I said, the Chinese business confidence fell to near decade lows. It has been about low volumes as we head towards the holiday week. Also seems to be putting some pressure onto the metal prices. Even as November, December have been good months, when you look at the current year 2022, many of those metals actually are closing this year in the negative. We have seen copper prices decline by 13%. Steel is down 16.5% for this year. Iron ore is down 7%. Aluminum 14%. Zinc 11.5% on the weaker side. So another year where we are looking at weaker moves coming in. The quarter could be on the positive side, but not 2020.
Welcome back. You're still with us on Markets Today. Well, let's run you through the rest of the headlines that we're tracking for you, which brings us to the fourth headline today. Just Style was down close to 2% in trade after Reliance Retail Ventures announced plans to trim its holding in the company. Rima standing by to run us through all those details. Rima?
Thanks so much for that. So Just Style's promoter Reliance Retail Ventures will be selling 2% stake in the company to achieve the minimum public shareholding requirement. The stake sale will happen in the open market. They are planning to complete the share sale within 8 days, beginning tomorrow, December 21st. As of 30th September, the Just Style promoter entity held close to about 77% stake, which is why they're looking to sell 2% stake, so they come down to 75% to comply with the requirements. Now, the stock Just Style has been down 20% in the last 1 year. It's currently hovering around 600, 610 rupees, and it's sharply lower than the time Reliance Retail Ventures had acquired the stake. In fact, Reliance Retail Ventures' open offer to acquire that incremental public 26% stake happened at a price of 1,022. So since that price, the stock has been a rank, underperformer.
Got it, Rima. Thanks for that. Well, Sterling and Wilson, well, that as well was down close to 3% after the company's promoters decided to lower their stake to meet the SEBI norms. Vivek Iyer, he's standing by to run us through quick details on that front. Vivek?
The stock in focus is Sterling and Wilson Renewable. Now, a promoter as well as the promoter group entities are looking to offload a little over 5.2% stake in the company, and this will be happening via the OFS route or the offer for sale route. Now, two promoter entities. First entity that we're looking at is Shapoorji Pallonji Group. Now they are looking to offload almost 3.69% stake in the company, with the base size at around 2.5% and the oversubscription option at 1.19%. Khurshid Daruwala, another promoter in the entity, is looking to sell close to 1.58% stake in the company, base issue size of a little over 1% and oversubscription option of 0.5%. Now, the floor price for this particular promoter OFS is at 270 rupees a share, and the main reason for this particular OFS, what is it and why is it that the promoter is paring stake in the company? This is mainly to meet the SEBI MPS or the SEBI minimum public shareholding norms. What we understand is that after this particular stake sale, the promoter will not be required to pare any further stake in the company because they will then be compliant with the SEBI norms.
Perfect. Thanks for that, Vivek. Well, moving on to the fifth headline today. Hinduja Global Solutions, that was down close to 3% after offering a buyback, at a hefty premium. This after the board, had close to around 1,000 crores in terms of a buyback. That's via the tender route itself. Rima stands by to run us through more details on that front. Rima?
Yesterday, the board met and they've approved a tender buyback of size 1,020 crore. The buyback size is a maximum of 1,700 rupees per share. So it is at a significant premium to where the stock is currently trading at. The cash on the books of Hinduja Global Solutions is also substantial, close to 1,672 crore as of 30th of September.
Got that, Rima. Well, Vivek's back with us to tell us about Jefferies. Well, they have exited Zomato, Bharti Airtel in their India model portfolio, according to a report from their equities strategy team. Vivek standing by to run us through all the changes that they have made. Vivek?
Well, that's right. A very interesting strategy note coming in. And what we are highlighting is, the kind of portfolio changes they've done as far as the model portfolio is concerned. So as the year winds down, they've made some tactical changes and, along with the rationale, they have highlighted the changes that they have made. So number one, recently Jefferies had raised quite a bit of cash as far as their India holdings was concerned. And they've now started deploying that particular cash into the metal sector. And also what they've done is they've shifted weight, from their holdings in Bharti Bharti, Zomato, as well as Maruti, and they have put this particular money into L&T, RIL, as well as the banking pack. Also, what they've done, they've gone ahead and added Tata Steel and Hindalco to the model portfolio, where because of that, the material sector rating has now gone to neutral from the current positioning that they had, which was nil. Also, what they've done, industrial sector is something that they like, so they've added weight to L&T, and now the industrial sector positioning has gone ahead and been increased to an overweight stance. They've added weight to RIL as well, and funding into metals has partly been done by removing cash from the portfolio, so deployed cash, as well as trimming their stake as far as Zomato is concerned. They've gone ahead and shaved or trimmed some stake and some weightage from Maruti, and this they've once again put it into banks. Also removed Bharti Airtel from the model portfolio. Now, looking at the rationale, number one, the additions that we mentioned earlier, metals, what they're saying is that the China reopening as well as the US rate peaking out is something that they believe can add further sentiment as far as positive sentiment as far as the metal space is concerned. L&T, they're seeing a pickup in the broader capex, and they also feel that order inflow here can be quite strong. RIL, what they believe is that the core, oil to chemicals business is something that will see increased business profitability, and petchem margins too will improve on the back of China reopening. On the other hand, some of the stocks where they have seen cuts, the rationale behind that, Zomato, they are incrementally wary, of potential rise in competitive activity in the sector. As far as Maruti is concerned, they see potential headwinds to discretionary consumption on the back of slower wage hikes as well as the IT sector weakness. And lastly, coming to Bharti Airtel, they are saying that concerns on rising 5G capex as well as the company not being able to raise tariffs as much as they would have liked is something that they believe bodes reasonably negative as far as Airtel is concerned.
Okay, moving on then. Meanwhile, Shipping Corp of India closed after, with some gains after the stock hit 52-week highs in today's trading session. Remember, they've come out with an update on the demerger process and also the increase in tanker rates. That's what's helped the stock do pretty well, but though it came off the high point of the day. Vaistha joins us for a quick analysis on that front. Vaistha?
Well, thanks for that. The big news why the stock is in focus today is because there is a divestment news on the stock which is coming in. The final hearing before the Ministry of Corporate Affairs for obtaining sanction on the demerger has been fixed on the 29th of December. And this is as per the directives of the MCA, which is issued during the hearing, which was held on the 16th of December. There was a delay in the process, though, which was due to a fake complaint which was filed in the name of a union earlier. So that is point number one. The second trigger in the stock is that the company largely operates in the tanker space, but there's a sharp increase in the tanker rates as currently, which have not yet been reflected very well into the results of the company. Also because the company operates on longer term contracts. So whenever there's a renegotiation of these contracts, the benefits would start flowing into the results. Anyways, the biggest stock for this trigger for the stock has been the demerger news. The stock has already rallied by about 60% in the past 6 months. So let's see how it moves again. Back to you.
Well, on that note, we'll have to wrap up on this edition of Markets Today. But before we leave, we have been speaking to market experts to get a sense of what the Lal Street could throw up in the new year. Here's what they had to say.
On valuations, we are starting at a fairly high point. Right, currently the market trades at 20 times 1 year forward. So we do expect that multiple tapers off a little bit.
Rural demand might do better than urban demand next year. One of the key risks that we are highlighting is that the excess savings of the pandemic is almost coming to an end.
There's a little bit of weakness in the IT stocks because the market tends to be short-term oriented. Yes, there is a recession in the West, which is the large buyer base for the Indian IT service industry. There will be some slowdown in terms of top-line growth and deal flow.
If some of the trends that are there today, if they continue, then hopefully it will be a better year. As compared to the rather unprecedented levels of food inflation that we had in 2022.